Someone told me once, instead of paying 15% in capital gains tax one time, you're better off taking a loan at 7% interest every year. I remember sitting there thinking, that has to be the worst financial advice I've ever heard. A 7% annual cost versus a one-time 15%. That math doesn't even take a calculator to disprove. And I think most people in your position feel the same way. You've spent 30 years building something. You're not interested in financial gymnastics. You're interested in not making a catastrophic mistake right before the finish line. So when someone online tells you to stop selling your assets and start borrowing against them, the reasonable response is skepticism. But here's the real tax picture. If you sell $100,000 worth of stock sitting on gains, you hand the IRS $15,000 before you see a dollar. If you borrow $100,000 against that same stock, you pay $0 in taxes. The shares keep compounding. The loan is not a taxable event. That's not a loophole. That's how the tax code is written. Debt is not income. The ultra-wealthy figured this out a long time ago. Warren Buffett, Elon Musk, Larry Ellison, they hold, they borrow, they live. Their accountants call it buy, borrow, die. The financial press calls it a scandal. The IRS calls it legal. But here's the question those flashy finance videos never bother to answer. And it's the only question that actually matters for someone your age. If you've retired, or you're close to it, where does the money come from to pay that loan interest every month? A 30-year-old with a W-2 salary can carry a loan. You might not have that paycheck anymore. So the whole strategy collapses unless someone tells you how to build the income that services the debt without you going back to work. That's exactly what this video is about. Not the headline, the mechanism underneath it. Let me back up and show you exactly how this system works, because once you see the structure, you cannot unsee it. Every dollar you earn from a job gets taxed on the way in. W-2 income, self-employment income, Social Security above a certain threshold. The IRS takes its cut before you even see the money. At the top bracket, that cut is 37%. Even at a modest income level, you're looking at 22 to 24 cents out of every dollar gone before it hits your account. Now compare that to what happens when you sell an investment you've held for over a year. Long-term capital gains. The rate drops to 15%, sometimes 20% for higher earners. Still a real cost, but noticeably lower than ordinary income. And then there's debt. Borrowed money is not income. The IRS does not consider a loan something you earned. So when money moves from a lender into your bank account, it creates zero taxable event. You receive the cash. You owe nothing to the government on that transaction. That asymmetry is the entire foundation of the strategy. Workers pay on income. Owners borrow against assets. It's not a moral argument. It's just how the rules are written. Now, a lot of financial channels have picked up on this idea and pointed people in one direction. Buy a short-term rental property. Do Airbnb. Use the depreciation write-off to offset your W-2 taxes. And on paper, there's something to that logic. Real estate depreciation is a legitimate tax tool. The problem is the fine print nobody reads out loud. I remember my first rental property. Not fondly. 10 months chasing an eviction. A tenant who stopped paying, stopped answering the door, and eventually left me a kitchen floor. I had to scrub myself on my hands and knees. I sat there in that gutted bathroom, grout brush in hand, thinking, this is not passive income. This is a second job with worse hours and no HR department. And I was younger then. I had the energy to absorb it. At 60, that is a different calculation entirely. The short-term rental strategy also has a structural problem that goes beyond the physical grind. To qualify for the real estate professional tax status that makes the depreciation offset actually meaningful, the IRS wants you to log over 750 hours per year in active real estate work. That's roughly 15 hours a week, every week, for the full year. If you're already retired, you just traded your freedom for a job that doesn't come with a salary. If you're still working, you're now managing two careers simultaneously. Either way, you are not living on your terms. The deeper trap is this. The people selling you the Airbnb dream are optimizing for tax savings in your 50s. They're not thinking about what your Sundays look like at 68. Selling assets isn't the answer either. Every time you liquidate a position that's been growing for 15 or 20 years, you compress decades of deferred gains into a single taxable year. You don't just pay 15%. You might push yourself into a higher bracket on top of it. And once that capital leaves the market, it stops compounding. That cost compounds too, just in the wrong direction. So you're caught. Sell and pay a tax bill that shrinks your nest egg. Or buy rental property and trade your retirement years for a maintenance schedule. There's a reason so many people in your position feel stuck here. It's not a failure of discipline or intelligence. It's that the options being presented are genuinely bad fits for where you are in life. If you've ever cringed at the idea of fielding a 2 a.m. call about a broken furnace, or dealing with guests who treat your property like a hotel room with no consequences, you're not being lazy. You're being accurate about what your time and peace are worth at this stage. That reaction is data. Listen to it. But none of that answers the actual question. If you're not selling assets and you're not buying rentals, how do you actually use this borrowing strategy without needing a paycheck to cover the interest? Before I show you the tool that solves this, we need to clear something out of the way first. Because even if the math makes sense to you right now, there's a memory in the back of your mind that's louder than any spreadsheet. 2008. If you were in your 30s or 40s in 2008, you watched something happen that most people never fully process. It wasn't just a market correction. It was a collapse of the core assumption that debt plus real estate was a guaranteed path to wealth. And the people who got hurt worst weren't reckless gamblers. They were people who followed the conventional wisdom of that era perfectly. Buy as much as the bank will lend you. Leverage everything. Let appreciation do the work. I knew people who were doing exactly that. A couple in their mid-50s, both professionals, owned 4 properties by 2007. Not speculators. Careful people. They had done the math. Rental income covered the mortgages, with some left over. Then valuations dropped 30% in 18 months. The equity they had borrowed against evaporated. 2 of the properties went underwater. The rental income barely covered 1 mortgage. They couldn't sell without locking in catastrophic losses. They couldn't hold without bleeding cash every month. By 2010, they were sleeping in a converted garage on their son's property while the bank processed the last foreclosure, in their late 50s. Starting over with nothing. That image does not leave you. And it shouldn't. Here's what actually went wrong for them, mechanically. They were borrowing at 80 to 90% of the asset's value. That's what's called a high loan-to-value ratio. When values dropped 30%, their LTV blew straight through 100%. They owed more than everything was worth. The math didn't just get uncomfortable. It became impossible. Margin calls in the securities world work the same way. If you borrow 75% against a portfolio and the market drops 15%, the lender can force you to either post more collateral or liquidate positions. Often at the worst possible moment, right at the bottom of a downturn, when selling means locking in the maximum loss. That mechanism, high leverage meeting a falling market, is the actual disaster, not debt itself. This is the part most finance content glosses over because it's not exciting. The distinction between dangerous debt and functional debt isn't about the type of asset. It's about the ratio. I'm not a 28-year-old telling you to mortgage everything and bet on appreciation. I've watched enough cycles to know that at our stage, a mistake doesn't come with a 30-year runway to recover. The math on time is just different now. But here's what I want you to hold on to. That fear you carry from 2008, it's not irrational. It's calibrated. It just needs to be aimed at the right target. The right target is overleveraging, borrowing 80% of what you own, borrowing against assets that produce no income, borrowing short to fund long. That's what destroys people. Borrowing 10% against a portfolio that generates its own income to cover the interest, while the underlying asset keeps compounding, that's a structurally different animal, different risk profile, different outcome distribution. Your 2008 instinct is not telling you to avoid debt entirely. It's telling you to avoid stupid debt, and that instinct is correct. The goal isn't to convince you debt is always safe. The goal is to show you a structure conservative enough that the 2008 version of events barely touches you. A setup where the market can fall hard, stay down for years, and you never receive a margin call, never get forced to sell. Never spend a night wondering if the math still works. That structure exists. And it doesn't require landlording, tenants, or 2 a.m. repair calls. So if you've been avoiding this conversation because of what you lived through 15 years ago, I understand that completely. But the question worth asking now isn't, is debt dangerous? The question is, what does a debt structure look like that your 2008 self would actually approve of? That's what we're building next. Here's the setup that solves the problem. Instead of buying a rental property to generate income and tax shelter, you build a portfolio of dividend-paying stocks and ETFs, blue chip companies, things that have been paying shareholders consistently for decades. Utilities, consumer staples, established financials. Not exciting. That's the point. Once that portfolio has enough value, you go to your brokerage and open what's called a Securities-Backed Line of Credit, an SBLOC. It works like a home equity line, except your collateral is your investment portfolio instead of your house. The brokerage extends you a credit line based on the value of your holdings. You draw from it when you need cash. That cash arrives in your account as a loan, not as income. The IRS sees nothing taxable. Your shares stay in the market. They keep compounding. They keep paying dividends. And those dividends, paid out quarterly by the companies in your portfolio, are what service the loan interest. That's the engine. Dividends pay the debt. The principal stays invested. You never sell. You never trigger a taxable event. Let me show you the math at a scale that's realistic for someone who's been building for 30 years. Say you have a $500,000 portfolio, not $5 million, $500,000. Most financial content would tell you to maximize the borrowing. Draw 70 or 75% against that portfolio. That's how you optimize. That's also how you recreate 2008 in miniature. Here's what a conservative structure looks like instead. You borrow $50,000. That's 10% of your portfolio value. Your loan-to-value ratio is 10%. At a borrowing rate of 6.5%, your annual interest on that $50,000 is $3,250. That's about $270 a month. Now look at your portfolio. A dividend yield of 3 to 4% on $500,000 generates between $15,000 and $20,000 per year in dividend income, paid quarterly, into your account. without you doing anything. $15,000 to $20,000 in annual dividend income covering a $3,250 annual interest bill. The dividend covers the interest more than 4 times over. The excess dividend income is yours to spend, reinvest, or hold as a buffer. The $50,000 you borrowed is tax-free cash in hand. You can use it for living expenses, a large purchase, a gift to your kids. Whatever you need liquidity for without selling a single share. Meanwhile, your $500,000 portfolio continues to grow. In a year where the market returns 8%, that portfolio added $40,000 in value on top of the dividends. Your $50,000 loan, in real terms, gets quietly eroded by inflation every year it sits there. You owe the same nominal number, but the purchasing power of that debt shrinks over time. I used to think the only way to use these tax rules was to go deep into real estate, active management, depreciation schedules, tenants. I spent years convinced that was the price of admission. I was wrong. For people at our stage of life, borrowing against a dividend portfolio is quieter, more controllable, and structurally safer than anything involving a property manager and a lease agreement. Now let's talk about what this actually unlocks long term. If you sell your appreciated assets the conventional way, that capital leaves the market and the compounding stops. You pay the tax once, but you also lose every dollar of future growth on the amount you sold. At 60, with a potential 25 to 30-year horizon, that's not a small number. If you borrow instead, your full principal stays in the market. Every dollar continues to compound. The loan gets serviced by dividends. And here's the part that most people never reach in these conversations. There's a provision in the tax code that, if you hold these assets until the end of your life, eliminates the capital gains liability entirely for your heirs. We'll get to that in a moment. It's the last piece of the structure, and it's significant. But first, you've seen the math on paper. The obvious next question is what happens when the market doesn't cooperate? What happens when you wake up and the portfolio is down 30%, the news is bad, and someone is using the word recession on every channel? Does this structure survive that? Let's run the scenario that keeps people up at night. You've set up the structure, $500,000 portfolio, $50,000 borrowed, dividends covering the interest. Everything looks clean on paper. Then one morning you wake up and the market is down hard. Not a 5% dip, a real downturn. The kind where the news anchors stop pretending it's temporary. You open your brokerage app and your portfolio is showing $350,000. What happens now? First, let's understand what triggers a margin call, because that's the actual fear. It's not a falling portfolio. It's a falling portfolio combined with too much debt against it. If you had borrowed 75% against your original $500,000, you'd be carrying $375,000 in debt. When your portfolio drops to $350,000, your loan balance now exceeds the value of your collateral. The brokerage calls. They want more collateral, or they start liquidating your positions. You are forced to sell at the worst possible moment, right when everything is down, right when selling locks in the maximum damage. That's the 2008 mechanism playing out in a brokerage account instead of a real estate portfolio. Same physics, different asset class. Now look at your position with the conservative structure. You have $350,000 left in the portfolio. You owe $50,000. Your LTV is now 14%. Brokerages typically issue margin calls when LTV approaches 60 to 70% of collateral value. You are at 14%. You are not even in the same conversation as a margin call. Let's push it further. Say the market drops 50%, a genuinely catastrophic event. Your $500,000 portfolio is now worth $250,000. Your loan is still $50,000. Your LTV is now 20%, still nowhere near the threshold. You do not receive a call. You do not have to sell anything. You sit with an uncomfortable brokerage statement and wait. And here's what history shows about waiting. Every significant market downturn in the last 100 years has eventually reversed. The people who survived 2008 financially intact were not the ones who sold in October 2008. They were the ones who had enough structural cushion that they didn't have to. Your dividend income may compress during a downturn. Companies sometimes cut dividends when their own earnings are under pressure. That's a real risk worth acknowledging. But even a 30 to 40% reduction in dividend income on a $500,000 portfolio still leaves you with $9,000 to $14,000 per year coming in against a $3,250 interest bill. The engine slows down. It doesn't stop. I've watched people who were well positioned going into a downturn destroy themselves anyway. Not because the math failed them, because the fear did. They saw red numbers every day for 6 months, couldn't tolerate the discomfort, and sold at the bottom to make the anxiety stop. Then they missed the recovery. The structure matters, but the structure only works if you trust it before you need to. What the low LTV gives you isn't just protection from margin calls. It gives you the psychological runway to do nothing, to turn off the financial news, to go to dinner with your spouse and not check your phone. That is not a soft benefit. That is the entire game at this stage of life. The fragility path, high leverage, maximum borrowing, chasing optimization, leaves you one bad quarter away from a forced decision at the worst possible time. The resilience path, conservative LTV, dividend-funded interest, full principal staying invested, means the market's bad days are someone else's emergency. When you've built a structure that can absorb a 50% market drop without a single forced action, you stop being a participant in the panic. You become a bystander to it. And once you've built that kind of stability into your financial life, there's one more mechanism in the tax code that activates quietly in the background. The part that determines what happens to everything you've built when it eventually passes to your children. That's what ties the whole structure together. Here's the part of the tax code that most people in your position have never been told about clearly. When you pass appreciated assets to your heirs, something happens to the cost basis of those assets. The IRS resets it. Whatever you originally paid for those shares, whatever the gain has been accumulating for 20 or 30 years, that entire history gets wiped. Your children inherit the assets at the current market value on the date of your death. That's called a step up in basis. And it means the capital gains tax liability you've been carefully deferring your entire life disappears completely at the moment of transfer. You never pay it. They never pay it. It's gone. Think about what that means in practice. You bought $80,000 worth of stock in your 40s. It's worth $500,000 today. If you sell, you owe capital gains tax on $420,000 of appreciation. At 15 to 20%, that's $63,000 to $84,000 handed to the IRS before a dollar reaches your family. If you hold, borrow against it, live off the loan and the dividends, and pass the portfolio to your children, they inherit $500,000 with a fresh cost basis of $500,000. They sell it the next day if they want. Zero capital gains tax owed. The debt strategy and the step up in basis aren't two separate ideas. They're the same idea. run to completion. Now, on top of that, there's been a significant change to how much you can pass to the next generation before federal estate tax applies. On July 4th, 2025, the One Big Beautiful Bill Act was signed into law. Starting in 2026, the estate tax exemption for a single individual is $15 million. For a married couple, that's $30 million that can transfer to your heirs completely free of federal estate tax. For the overwhelming majority of people watching this, that exemption covers everything you've built. The entire portfolio, the house, everything. Your children receive it intact. 3 steps to position yourself for this correctly. First, restructure your portfolio toward quality dividend-paying assets, not speculative growth stocks. Established companies with long dividend histories. This is what funds the interest on your SBLOC and keeps the engine running without you selling anything. Second, contact your brokerage and ask specifically about their Securities-Backed Line of Credit program. Understand the terms, the interest rate, and the LTV thresholds that would trigger a call. Then commit to borrowing no more than 15% of your portfolio value. Write that number down. Make it a rule you don't negotiate with yourself. Third, work with an estate planning attorney to set up a living trust. This is the structure that locks in the step up in basis for your heirs, keeps your assets out of probate, and ensures the $30 million exemption is applied correctly for your family. It's not complicated. It's a half day of paperwork and a one-time conversation with a professional who does this every week. These 3 steps don't require you to become a real estate investor. They don't require a second job. They don't require you to bet everything on a market call. They require a portfolio, a credit line, and a document. That's the whole structure. Most of what gets sold to people your age is built around one emotion. Fear. Fear that you started too late. Fear that you missed something. Fear that one wrong move erases everything. That's not what this channel is about. What we've walked through today isn't a get-rich scheme. It's a structure. Borrow conservatively against assets that generate their own income. Let dividends service the debt. Keep the principal compounding. Pass it forward with the tax basis reset. No tenants. No margin calls. No scrambling. At this stage, the goal isn't to maximize return. The goal is to stop doing things that quietly destroy what you've already built. Selling appreciated assets unnecessarily. Over-leveraging into real estate that costs you your weekends and your peace of mind. Leaving your heirs a tax bill that didn't have to exist. Winning at 60 looks different than winning at 30. It's not about the highest number. It's about the most durable structure. The one that holds through a bad market, a bad year, a bad decade, and still delivers on the other side. If today's video gave you one thing worth sitting with, I'd want it to be this. The complexity here is not as intimidating as it looks from the outside. A dividend portfolio, a conservative credit line, a living trust. That's the framework. Everything else is refinement. If you found this useful, subscribe so you don't miss what's coming next. And drop a comment below. What's the biggest concern you have right now about using any kind of leverage at this stage of life? I read those. They shape what I cover next. I'll see you in the next one.